VOO is the biggest ETF on the planet. Over $1.6 trillion in assets, more money than the GDP of most countries. And if you used it to build your retirement savings, congratulations, you made one of the smartest moves in investing history. But here's a number that might stop you cold. Right now, VOO pays a dividend yield of about 1%. On a $1 million portfolio, that's roughly $10,500 a year in dividends. If you need $50,000 a year to live on, and most retirees do, where does the other $39,500 come from? You sell shares. And selling shares in a down market is exactly how good portfolios go broke. Not because of bad decisions, because of bad design. Today, I'm going to show you why VOO alone cannot pay your retirement bills, even when the returns look great on paper. And then I'm going to show you a simple 3-bucket fix that solves it. The specific ETFs, the specific dollar amounts, and the exact math to hit $50,000 a year in retirement income. And the part most people miss, the fix doesn't mean selling VOO, not a single share. Quick note, I'm not a financial advisor. Everything here is for educational purposes only. For your specific situation, always talk to a qualified professional. Let's get into it. The retirement trap hiding inside VOO. Here's what most people get wrong about VOO in retirement. They look at the long-term average return, about 10 to 11% a year, and they think, I'm fine, I'll just pull out 4 or 5% and the growth covers the rest. If you're 35 and still adding money every paycheck, that logic works. You have decades to ride out any crash. But something changes the day you retire, the day you stop putting money in and start taking money out. Let me make it real. Say you retired on January 1st, 2000 with $1 million, all in the S&P 500. You follow the 4% rule. Pull out $40,000 a year adjusted for inflation. That's the rule everyone told you was safe. Before I show you what happened, take a guess. Where do you think that portfolio ended up by 2009? $1 million? $800,000? By the end of 2009, that portfolio had dropped to roughly $455,000. 10 years following the rule, and you lost more than half your money. Even worse, by 2019, nearly 20 years later, the portfolio was still below $400,000. Now here's the part that really stings. A retiree who held a simple 60-40 mix, 60% stocks, 40% bonds, ended that same lost decade at about $733,000. Same starting amount, same withdrawal, a gap of nearly $280,000. All because one portfolio had a cushion and the other one forced you to sell stocks at the worst possible time. This is called sequence of returns risk. When you sell shares during a downturn to pay your bills, those shares are gone forever. They never compound for you again. Think about it this way. Every share you sell at a 30% discount is one less share working for you when the market recovers. Multiply that by 3 or 4 years of a bear market, and the damage becomes permanent. And here's the thing, January 2000 isn't ancient history. The CAPE ratio back then was about 44. Today, it sits around 41. That's the second highest reading in 140 years. We are close to identical conditions. So the question isn't whether VOO is a good investment. It is. It's the best growth engine most people will ever own. The question is whether it's designed to pay your bills in retirement. And the answer is no, not by itself. But the crash risk isn't even the immediate problem. There's a quieter issue. Let me show you. The 1% income problem. Here's the myth. VOO is diversified because it holds 500 companies. Here's the truth. Right now, about 36% of every dollar in VOO sits in just 10 stocks. Roughly 33% of the fund is in one sector, technology. The Magnificent Seven, NVIDIA, Apple, Microsoft, Amazon, Alphabet, Meta, and Tesla, make up about a third of the entire fund.
That's not diversification. That's a concentrated tech bet with a 500 stock label on it. And those mega-cap tech stocks, they barely pay dividends. NVIDIA yields basically nothing. Alphabet pays about 0.3%. That's what drags VOO's yield down to levels we haven't seen since 1999. Let me put a real number on it. On $300,000 in VOO, you get about $3,150 a year in dividends. Same $300,000 in SCHD, the Schwab U.S. Dividend Equity ETF, pays roughly $9,600 a year. That's 3 times the income on the same amount of money. And SCHD has been growing its dividend by about 10.6% per year over the last 5 years, meaning your income keeps rising even without adding a single dollar. So if you're retired and relying on VOO for income, you're being forced to sell shares to make up the gap. And selling shares in a down market is, well, you already saw what that does. If someone you know is retired with most of their money in VOO, they need to hear this part. Send them this video. Quick question before we move on. Is VOO your biggest holding in retirement, or have you already started blending in dividend ETFs or bonds? Drop it in the comments. I read every single one, and I want to see what your setup looks like. Now, let me show you the fix, and I mean the real fix, not a vague suggestion. Specific ETFs, specific dollar amounts. The 3-bucket fix. You don't sell VOO, you fix how you use it. The answer is a 3-bucket system. It was originally designed by a financial planner named Harold Evensky, and it's taught today by Christine Benz at Morningstar, one of the most respected voices in retirement planning. Here's how it works. Bucket 1 is your cash bucket. This holds 1 to 2 years of living expenses. You put it in something safe, like SGOV, a short-term treasury ETF which yields about 4.3% right now, or a money market fund. This is your shock absorber. When the market crashes, and at some point it will, you spend from this bucket. You never touch your stocks during a downturn. That's the entire point. Bucket 2 is your income bucket. This holds about 8 to 10 years of spending. You fill it with bonds and high-quality dividend ETFs. BND, the Vanguard Total Bond Market ETF, yields about 4.5% right now. SCHD yields about 3.2% with strong dividend growth every year. This bucket generates steady income, no selling required. Bucket 3 is your growth bucket. This is where VOO stays, long-term compounding, untouched for at least 7 to 10 years. It has the time to ride out any crash, recover, and keep growing. 3 buckets, 3 jobs. Cash protects you, income pays you, growth compounds for you. Now, I want to be honest about something because I think trust matters more than hype. Michael Kitces, one of the sharpest financial planners in the country, ran the math on bucket strategies. What he found is that buckets don't actually produce better long-term returns than a simple rebalanced portfolio at the same stock-to-bond ratio.
The math is nearly identical. So why use buckets? Because in March 2020, when the market dropped 34% in a single month, knowing you had 2 years of cash sitting in bucket 1 is what stopped you from panic selling VOO at the bottom. The bucket strategy isn't a math trick, it's a behavior trick. And over 30 years of retirement, behavior is everything. The $50,000 a year math. Let me walk through the actual numbers. Say you've got $1 million. Here's how the 3 buckets break down. Bucket 1, cash. You put $100,000 in SGOV. At 4.3%, that generates about $4,300 a year, and it covers 2 full years of living expenses if you need it as an emergency cushion. Bucket 2, income. You put $400,000 here. Split it between SCHD and BND. Let's say $200,000 in each. So $200,000 in SCHD at 3.2%. Let me do the math. That's about $6,400 a year. And $200,000 in BND at 4.5%, that's about $9,000 a year. Total from Bucket 2, $15,400 a year. Bucket 3, growth. The remaining $500,000 stays in VOO. It throws off about $5,250 a year in dividends at its current yield, but you're not relying on that for income. You're letting it grow. Now let's add it up.
Bucket 1 gives you $4,300, Bucket 2 gives you $15,400, VOO's dividends add $5,250. That's roughly $25,000 a year in passive income without selling a single share. For the other $25,000, you draw down your cash bucket and refill it periodically. When markets are up, you rebalance growth into income. When markets are down, you leave VOO alone and spend from cash. But, and this is important, I need to be straight with you. $50,000 a year on a $1 million portfolio is a 5% withdrawal rate. That's above Bill Bengen's safe rate of 4.7%. It's well above Morningstar's base case of 3.9%. So how do you actually make it work? Guardrails. The idea is simple. In a bad market year, you cut your spending by about 10%. In a good year, you give yourself a raise, up to 10%. That's it. Morningstar's research shows that this kind of flexible approach pushes the safe starting withdrawal rate above 5%. That's the difference between $39,000 a year on a rigid plan and over $50,000 a year with a little flexibility built in. Smart retirees don't lock in one number for 30 years and hope for the best. They adjust, and the 3-bucket system gives you the structure to adjust without panic. Are you safe right now? There's one last thing you need to know, and it might be the most important piece in this entire video. Bill Bengen, the man who invented the 4% rule, updated his research in August 2025. His new safe starting withdrawal rate is 4.7%, but here's the part people miss. That number assumes a diversified 7-asset class portfolio: stocks, bonds, small caps, international, and cash, not a 100% VOO portfolio. In other words, the safer withdrawal rate is only available if you diversify, which is exactly what the 3-bucket system does. Goldman Sachs projects the S&P 500 will return just 3% per year over the next decade. JP Morgan is more optimistic at about 6%, but even their estimate is less than half of what we've seen over the last 10 years. Does that mean the sky is falling? No, it means this is not the time to have all your eggs in one basket, especially when that basket pays you 1%. Here's what I want you to remember from this video. Write this down. VOO builds the wealth, but it was never designed to pay the bills. 3 buckets turn a growth engine into a retirement paycheck. The fix isn't complicated. 3 buckets, 1 afternoon to set up, and the discipline to leave VOO alone when the rest of the world panics. What's your current setup? Are you all in on VOO, or have you already started building your buckets? Tell me in the comments. I'm genuinely curious. If you're building retirement income and want to stay ahead of moves like this, subscribe to this channel. I cover everything that protects your paycheck in retirement.